Do you ever look at a stock and wonder if it's a good buy or not? I'm going to go through the process of valuing a stock in this video, but you got to watch the entire video because throughout there's going to be pop-ups like this showing you valuable information on graphs, charts, and real detail on the information and the financials I'm discussing. So let's get started. So Vornado Realty Trust is a REIT formed in Maryland with its primary office in New York City, and it mainly invests in office buildings and retail spaces in Manhattan. In this video, we're going to go through the process of valuing a company using a discounted cash flow model. And the way you do that is you estimate the future free cash flows of the company, then you discount those cash flows back to today's dollars, and then you identify the intrinsic stock price and compare it to the actual stock price that it's trading at and see if it's a buy or a sell. And we're going to also look at the financial ratios of the company and compare it to its competitors. Let's get started. So what's the market cap of it's $7.677 billion. And the market cap is the value of the company according to the stock market. And market cap is the same as stock price times shares outstanding. And let's get the free cash flow of the company. And this is the cash that's left over after operating its business and paying for capital expenditures. So this is why you invest in a business, for cash. And if they don't have any free cash flow remaining, that's a big red flag. Net income is the profit and loss. That's a profit and loss based on accounting standards and accrual accounting. Revenue is sales. So for Vornado, it's the lease and rent payments on the real estate it owns. That's what the sales are. We also need to look at the capital structure of the company because we want to know how much to discount the future cash flows by. And they paid $262 million on their debt payments. Now let's see how much debt they have. We'll go to the balance sheet for that. They have no current debt. They have $7.4 billion of long-term debt. So all their debt is due after 12 months. And they pay 3.5% interest on the debt. REITs do not pay any taxes, so we don't have to discount their interest payments. Let's also get some more information from the balance sheet. Let's get their current assets. That's $2.8 billion. That's assets that can be liquidated into cash within 12 months. And their current liabilities is $838 million. Those are liabilities and debts that are due within 12 months. Let's get the equity. That's the value of the company according to the balance sheet. It's total assets minus total liabilities. And EBIT, operating income, which is earnings before interest and taxes. That's $417 million. So next, let's get the beta. That's the volatility of the stock. And it's 1.36. So the stock moves a little more than the market moves. So to get the weighted average cost of capital, it's a blend of the cost of debt and the cost of equity. And equity is usually more expensive than debt because equity sits lower in a capital structure. In the event of default, equity holders are paid after debt holders. So the WACC of 7.94%, that's what we're going to discount the future cash flows by. And we estimated the future free cash flows based off of the inputs we put in earlier. And then we did a terminal value, which is all years past 4 years. And then we discounted those numbers based off of the WACC. And we get a value of the company of $9.2 billion. And when we divide that by 191 million shares, we get an intrinsic stock price of $48. So it's a buy according to the model because it's trading at $40. And it looks like it was trading well above that price. It was trading in the 70s, 80s, even maybe 90s. So it's dropped a lot since coronavirus. It's much more in line with intrinsic value. But as you know, a stock can always trade higher or lower than intrinsic value. It's based off of supply and demand of the market. If more people think the stock is worth more than $40, they're going to buy it. If more people think the stock is worth less than $40, they're not going to buy it, or they're going to sell what they have. So the price really moves based off of supply and demand. And people have different ways to identify this. They use fundamentals like we did, the financials. You could also use technical factors and market sentiment. So the only way to really mitigate these types of things is to hold the stock long term if you do feel the stock is worth value in the future and it's going to go up. But nobody can predict the present or the next few months, that is. So let's look at their financial ratios. So their PE ratio is their stock price over earnings per share, and that's really low, 2.4. I like to see under 15. So a low PE is a good sign, but you have to make sure it's not low because they have a lot of debt, or it's low because they bought back stock. Same thing with the price of sales and the price to book. Price of sales is actually higher than what I like. I like to see under 2.2. They have 4.0. That's stock price over sales per share. So I'm going to show you how price to sales ratio works. It's just the stock price over the sales per share. And sales per share is revenue over shares outstanding. So let's just say this company bought back shares. Say it reduced its share count by 20%. So it's bought back 20% of shares. See, it brings down the price to sales ratio to 3.2. It was 4.0. And then they brought it down from 191 million shares to 153 million shares. So you could bring these ratios down if you buy back stock. Another way to improve your price to sales ratio is if your revenue goes up. You can see this company had 2.5 billion of revenue in 2016. 2019 it dropped. So let's just say revenue increased 20%. So now the price of sales looks more attractive. The lower the price of sales, the better. It's 3.3. But say the stock went up to what it was at in the past, and it doubled over the next few months. The price sale is now look terrible. It's up to 8. So the company can alter these numbers. If they buy back shares, that's one way to do it. And if they aggressively grow their revenue, and you can do that by taking on a lot more debt. Because if they added a few $100 million of debt, they could just buy a few more office buildings. And granted, they may not be profitable on those buildings, but they could drive up their revenue, which will help these ratios. Of course, their profits may suffer. Let's look at the price to book ratio. And it's similar to where stock buybacks can improve these numbers. They have a good price to book. I like to see under 3.3. They have 1.1. This is current ratio. That's current assets over current liabilities. And this just shows you how much money you have to fund your current payables. And they have more than enough, probably a little too much. So they may be sitting on a little too much cash. Next is ROE, and their ROE is great. That's net income over equity. And above 20% is what I look for. They have almost 50%. So they're providing a great value to their investors. It looks like the interest coverage ratio is a little low, 1.59. 1.5 or low is a big red flag. That's how many times you could cover your interest payments. So the formula is simply EBIT, which is the 417 million we input earlier. That's your operating income. And then over interest expense. So they can't even cover their interest expense 2 times. So more than half of their operating income is going to the interest payment. So that is definitely a red flag, because if they don't become profitable this year and next, which is likely the case with coronavirus affecting a lot of businesses, they may struggle in this category and may need to take on more debt, which increases their interest expense. Let's see how VNO stacks up against its competitors. So I have the ratios here on the side, and then the tickers of the other REITs up here. There's 11 REITs, and I've done discounted cash flow videos on all 11, and that's why they're in this video. The winner of each category, and I put a couple of companies in red because they have over 80% debt. So I don't want their low ratios to persuade me that they're a good buy, because any company that's almost 90% debt, I'd be really concerned about. And VNO looks like it's in good shape in most categories. They do have over 50% debt, which isn't ideal. The average REIT has 63% debt, so they're below average. So you have to look at things when you compare it to the entire industry. You can't compare all companies in the S&P and say, okay, the average company, and I'm making this up, has 20% debt. Therefore, VNO is a bad investment. You have to look at it against its competitors, and then you'll get an idea whether it's a good number or not a good number. So the PE, VNO is in really good shape. There's a bunch of companies that have PEs below 15. They're a little high in price to sales ratio. A couple of businesses have really good price to sales ratios. Price to book. It seems like just about every REIT has a good price to book. A couple of REITs have a current ratio below 1, so that's a big red flag. They won't be able to fund their current operations and they'll need to take on more debt. But VNO has plenty of cash to fund its liabilities and current debt. And VNO wins the battle in ROE. They have 40% return on equity. That's amazing. And they're much better than all the other REITs. AMT has a good ROE at 34%, but they have 81% debt, which is obviously a bad sign. What is your opinion of REITs? Do you think it's a good investment or not? Thanks for watching the video.